you're going to be at $200 silver. And my bet is, oh, sure, yeah, at some point up there, you're going to get a $50 sell-off or more, something you want to avoid if you're trading. But you're in a new price reality. You're going to live in a new range between 150 and 250, maybe. I don't know, maybe even higher. Depends on the degradation of the money unit that will likely happen if the stock market breaks down and sparks the central banks again into doing what they love to do. You do the math. If gold went to 8,500, which is to say nothing but replicating what it's done twice before, and silver went to 2% of that, silver would be $160. If silver went to 3% of that, you get the point. Okay. Silver has a major catch up to do, not only in relative performance to gold, which it's going to do, but in net price.
Market analyst Michaeloliver believes we're entering a whole new era for silver. Not just a temporary rally, but a complete revaluation. He points out that while silver may see sharp corrections along the way, even a $50 pullback on the overall trend is toward a much higher trading range. In his view, we're heading into a new price reality where silver could comfortably move between $150 and $250 per ounce, or potentially even higher depending on how fast global currencies lose value. Oliver highlights a critical relationship between gold and silver that's been out of balance for years. Historically, silver has always played catch-up to gold's big moves, and it's long overdue. If gold were to reach $8,500 per ounce, simply matching its past performance levels, then silver at just 2% of gold's value would sit around $860. At 3%, it could climb beyond $250. This projection isn't just speculation. It's grounded in patterns we've already seen twice before. The real driver, Oliver suggests, will be the degradation of money itself. As central banks respond to stock market breakdowns with more liquidity and stimulus, silver's intrinsic value may finally assert itself. Stay informed. Like, share, and subscribe for more insights on the metals market and what's coming next.
The one thing I would argue is this: those people who are thinking about, oh, when the top comes, that's it, you have a bear market. You might, but we're going to be in a new price reality at that point. And silver, for example, if I'm correct on it, and I think I am, if you come up out of this, not just the price base, which any idiot could see, but you blow that spread out and you go up to 2%, 3% of the price of gold again, you're going to be at $200 silver. And my bet is, oh, sure, yeah, at some point up there, you're going to get a $50 sell-off or more, something you want to avoid if you're trading. But you're in a new price reality. You're going to live in a new range between 150 and 250, maybe. I don't know, maybe even higher. Depends on the degradation of the money unit that will likely happen if the stock market breaks down and sparks the central banks again into doing what they love to do, destroy the money unit. Anyway, but this chart screams at you. I've got open field running above me, and I've set that structure pristinely. It lived in a range between 17.5% and 30% for those dead decades up there, where the relative performance of the miners meant that they were of that value of an ounce of gold. They were worth 17.5% to 30% of an ounce of gold. They collapsed to 4% in 2015 bear market. Off the page. They've since rallied. You're pushing up again toward what? About 8%. You can see the basing action. You clear that and you can run to that 17.5% quickly. It's an open field running again. That's a tripling almost in the relative value, a double and a half of the current relative value of the XAU gold silver miners versus gold. If the silver miners are depressed to gold miners, just like silver is to gold, they're both as a category going to outperform gold or gold miners. And as we just saw in XAU, which does contain some silver miners, there's a good chance you could double and a half the relative performance of that category to gold and probably do even better in the silver components within the mining sector. So if I had to emphasize something, the best to hold in that monetary metal sector over the next 6 months, or year and a half even, silver and silver-related miners. Imagine if silver catches up, which we think it will, but in a thunderbolt. So not only does gold have the potential just to replicate the two prior bulls, which I think it will vastly outpace, by the way, ultimately, silver will catch up, and that'll be an enormous move. Even if silver, if you go back 50 years and look at silver versus gold spread and ask yourself, what's the highest reading that silver had versus gold as a percent scale? And right now we're at 1.2% of the price of gold. In the last 50 years, it's 20 of those 50 years, it's been at 2% or higher. If we even just went to 2% or higher, that's almost a doubling of the current valuation of silver to get back to what's a norm over the last 50 years. If you then go back and look at bull market years in silver versus gold, silver and gold, 79 to 80, for example, 2010-11, that spread was up to 3.5% or even 6.5% back in 1980, but well over 3%. Now, if we went to 3%, that would be a tripling in the current value of silver to gold. The correlation between oil, for example, and economic weakness is not really good. We've had times where you're in recession and so forth, and the Bloomberg goes up and oil goes up with it. So the attempt to connect copper, for example, that is called Dr. Copper, I think, it's like the symbol of the economy, is not valid, technically speaking. Overlay it on recession charts or something like that. Copper, platinum, oil, all those commodities tend to move as a fairly good group within the Bloomberg. They tend to move together as a cluster. And they don't correlate well to global recession. And go back to the late 70s to 80s when gold exploded, Bloomberg finally in 1977 joined the gold trend, which is already headed up, and soared, not as much as gold, but strongly. It was a global recession. Okay. And the other factor of commodities, and oil too, look at its price. Like Bloomberg Commodity Index in 2008 was at 237. Right now it's 105, and you're calling commodities expensive? It's a cheap asset category. So is oil relative to prior highs, 130, 140. It's less than half those prices. So an economic downturn, it's already reflected one. It can go up if it wants based on other factors. Anyway, so that's something I'd be watching. I'd be watching Bloomberg and even oil because, oil looks like a dog right now. But you get up to 68, and on a price chart, that doesn't mean much. But on long-term momentum, you get up to 68 and close a month there or higher, any month this quarter, and that's a green light. You're going up. And probably with a slingshot effect, pretty strong surge. Platinum is a good example recently. People like to correlate it to gold, and it doesn't correlate at all to gold very well. There's a few times in history where it does, but most of the time it is linked to the Bloomberg, meaning it behaves like, in general, a commodity. But it has shifted into positive trend a few months ago by our metrics. We got bullish hundreds of dollars below where it is now. So it's ahead of the Bloomberg right now, but it still moves like that pack of commodities. But platinum has come out of a totally inverse relationship to gold over recent years. While gold's been rising, it's been at a cheap base of action. No rise at all. No correlation.
Analyst Michael Oliver presents a compelling outlook on the unfolding transformation in precious metals, particularly silver. He argues that we're not just facing another cyclical high, but entering a new price reality. Once silver breaks out from its long consolidation, he foresees it trading within a range of $150 to $250 per ounce, possibly higher, depending on how much fiat currencies degrade as central banks respond to future market crises. Oliver explains that the relative value gap between silver and gold is unsustainably wide. Historically, silver has traded at 2% to 3% of gold's price, but it currently sits near just 1.2%. A return to those historical ratios alone could double or triple silver's price, even without a major gold rally. He also points to silver and gold miners as the sector with the strongest upside potential. The mining stocks, currently undervalued relative to gold, could see their performance multiply as silver begins to catch up. Beyond precious metals, Oliver notes that commodities like copper, platinum, and oil remain undervalued, despite global economic concerns. He views this as part of a broader setup where hard assets, not equities, lead the next major move. Let's get into the interview.
Because I know a lot of people think gold goes up because of uncertainty in the world. That's baloney. It goes up because of the ongoing degradation in the money unit. It inhales and it exhales, but basically it's constantly discounting the destruction that governments inflict on their money unit, over the decade by decade destruction, inflating, etc. That said, commodities are cheap relative to that asset category. Stock market is appreciated because of that degradation in the money unit, because all that cheap money, free money, went into the stock market for 15, 16 years. They ignored a cheap asset category. Here we look at crude oil at 57. Go back to your left. You go back 3-4 years. And when that war started, crude peaked literally weeks after the late February 2022 high. So when the war started, which was a surprise to many analysts, foreign policy analysts, so it wasn't like it was being discounted,
Right.
but you soared from 2020 lows, same with the Bloomberg Commodity Index, from that 30 level to 130 without a war. When the war started, you went down, okay? Imagine what happens if you have world peace and all the people who think that, oh, it's uncertainty that causes things to go up. That's what caused oil. No, oil didn't go up because of uncertainty. When the war started, oil went down. Okay. In fact, even when the war started, gold dropped from $2,000 to $1,600 between March of 2022 to October of 2022. People say, what the heck's going on? I thought it was global uncertainty or gold. That is not a factor. It's relative cheapness of an asset compared to the ongoing decay in the real value of the money unit. For the last 15 years, the stock market got all the benefit of that, but it went to a point of excess. If suddenly the stock market says, oops, like it did a dot-com high, and says, oops, I made a mistake, I'm going to compensate for it, that renewed money flow, which the Fed always does in bear markets in the stock market, they come in to print more money and cut rates. It never works. It goes somewhere else. Cheap commodity asset category is one prime candidate. And oil at $57 compared to recent years is a cheap asset category. And one of the drags on the Bloomberg lately has been recent weakness in oil, which I don't think will continue, but it has been weak. But surely you could look at gold over the last months or beginning of this year and then look at oil. They're not in sync at all. Oil's been weakening, gold going vertical, same with silver. In fact, silver is up more year to date than gold is. Most people don't know that. They think silver's the dog, but it's asserted itself pretty strongly, especially since April, May. It turned
60%, right? 65, 66%.
I think it's up more than gold. I know that on a percent now. It's still got a lot of catching up to do to get back to normal levels, like 2% of the price of an ounce of gold. But it has been strengthening sharply this year.
Many assume gold rises because of global uncertainty, but that's a myth. What really drives gold, and soon silver, is the steady decay of money's true value. Decades of inflation, money printing, and artificial stimulus have quietly weakened the currency, while the illusion of growth filled the stock market. That easy money didn't create prosperity, it just inflated paper assets. Now, as markets wobble and the next crisis looms, those same policies will likely return. And this time, the flow of capital may shift toward hard assets. Commodities like oil, platinum, and especially silver remain deeply undervalued. Oil at $57 a barrel, for instance, reflects not weakness but opportunity. Even now, silver has begun to outperform gold, up sharply since spring. It's reclaiming its historical strength, and the catch-up could be dramatic once it reaches just 2% of gold's price. This isn't just about market moves, it's about a shift in value itself, away from inflated paper toward tangible wealth. When money loses meaning, real assets regain it, because in every cycle of monetary decay, one truth holds. Gold and silver don't change. Only the money around them does. Stay informed, like, share, and subscribe for more insights on the metals market and what's coming next.